We hope you're having a healthy and fulfilling summer as the weather is hot and the days are long. There's no shortage of investment themes encountered by investors in 2025. U.S. equities were volatile in the first half of the year, and the bellwether S&P 500 equity index, after posting gains in January, traded lower for 3 consecutive months, February, March, and April, only to surge higher in May and June. When it was all said and done, the S&P 500 had gained 6.2%, including dividends, in the first 6 months. A considerable achievement considering that as of early April, the index was down more than 15% year to date and down nearly 19% from the highs in February. The index closed at an all-time high on June 30th, 2025, and was even up a little bit more in the first 2 weeks of July. The primary source of volatility in our view was tariff and trade policy, as escalating tariffs and retaliation, a trade war, has negative implications for economic growth, corporate earnings, inflation, and interest rates. When the trade rhetoric was at its peak in early April, equities were at the 2025 lows. This quickly reversed starting April 9th when the Trump administration put a 90-day pause on many of the announced tariffs and became receptive to negotiations and bilateral trade agreements. This might have been the plan all along and reflected a pivot in policy, or at least a change in how the policy was communicated. If we say an avoidable trade war would be a scuff or a divot, we can also say that investors like policy pivots over policy divots, which inspired the title of our quarterly market outlook. This video complements our quarterly outlook, which was published in mid-July, and the report highlights 5 key areas for investors. Our S&P 500 fair value estimate is 6,100. Valuations are high, which limits near-term upside, but value can be found. Long-term interest rates could remain high even if the Federal Reserve Bank cuts rates. Economic growth has slowed, but markets expect more, and volatility is not over, especially as tariff threats heat up again. Our S&P 500 6,100 fair value estimates 5% higher than our view in April, as we incorporate better than expected first quarter earnings growth and a narrowing of the range of potential economic outcomes. This is mostly because the downside economic outlook has improved, along with the pivot on trade. The economy can benefit from trade deals, but also from capital project incentives in the recently passed budget bill and ongoing investment for generative AI and its necessary infrastructure. Now, 6,100 is below the current index level, which is near 6,200, so we are basically at fair value. And this is due to an elevated price to earnings, or PE ratio, which divides the index price by estimated earnings for the next 4 quarters. At a current PE above 22 times estimated earnings, it's above the 10-year average that's just below 19 times. If a growth accelerates in the second half of 2025, gains could continue, but potential earnings disappointments remain a risk. The S&P 500's high PE valuation relative to its long-term average limits the upside potential over the near term in our view. Equities could trade higher if earnings growth exceeds expectations, but if not, we don't expect PE expansion. For potential relative market gains, we can look at the equal weight S&P 500 index. This adjusts for the S&P 500's dominance and market capitalization by the largest companies, which includes the Magnificent Seven and a few others. The equal weight S&P assigns each stock an equal weight, giving more of an emphasis on the average stock. The equal weight S&P PE is in line with its 10-year average and trades at a discount to the S&P 500, offering better relative value in our view. One way to gain exposure to this is by adding more balance through sector diversification. The equal weight S&P has lower exposure to technology and communication services and more exposure to industrials, utilities, materials, real estate, and energy. An upside from the average stock on the equal weight S&P can come from either earnings growth or PE expansion, or both. The yield on U.S. 10-year Treasury bonds, in our view, is a proxy for long-term interest rates. Despite some volatility, the yield was range-bound in the first half, and as of June 30th, the 10-year Treasury yield was 4.23%. A yield above 4% is much higher than the average 10-year Treasury yield since 2016 of 2.6%, and many investors believe that inflation continues to trend lower, the rates will normalize below 3%. But we caution that rates could stay above 4% longer than some expect. Since 1990, a period of 35 years, the 10-year Treasury yield averaged nearly 4.3%, very close to where we are today. Multiple global inputs factor in a demand for Treasury securities, which impacts bond prices and ultimately interest rates. The Federal Reserve Bank, or Fed, controls very short-term overnight interest rate targets by setting and managing a target for Fed funds. But the Fed's ability to manage long-term rates is limited. Bond investors will watch multiple domestic and global factors, but the supply of U.S. Treasuries, which is more borrowing, will continue to increase along with the rising annual budget deficits. We believe this could keep interest rates at levels more in line with those long-term averages. U.S. economic growth, as measured by gross domestic product, or GDP, is expected to slow from post-pandemic levels. Over the 3 years 2022 through 2024, U.S. GDP, adjusted for inflation, grew an average of 2.7% annually. The Wall Street consensus estimate from FactSet for 2025 GDP growth is 1.5%, and this has trended lower over the past few months. 2025 economic data is a little noisy due to tariffs, which have disrupted imports and exports and altered some behavior ahead of expected price increases. But the private economy, which includes consumer spending, business investment, and housing, comprising more than 80% of the U.S. economy, collectively have delivered growth. Housing has been weak, but business investment has surged, and consumer spending has remained resilient at levels a bit lower than last year. An indicator supporting consumer resiliency is the labor market, and monthly jobs gains in 2025 were better each month in the second quarter compared to each month in the first quarter. After the equity market's strong recovery from April lows to new highs, we believe that investors and markets are pricing in stronger 2025 economic growth than what's reflected in the estimates. This creates some risk if GDP trends disappoint, but could be supported by progress on trade deals, continued labor market strength, and technology investment. In 2025, we've reiterated our core investment principles to keep long-term time horizons, prioritize high-quality assets, set portfolio and asset allocation goals, and rebalance regularly. Long-term investors should remain invested and resist impulsive changes. The first half of 2025 was a great example of that, as the S&P 500 dropped to 15-month lows, then rallied to make new highs, all within the same quarter. Within the S&P 500 sectors that led the first quarter decline rallied to lead the recovery in the second quarter, while sectors that delivered gains in the first quarter dropped as the overall market recovered. This created opportunities to rebalance positions by trimming highly appreciated holdings and adding to companies and sectors that pulled back. We advise investors to stay the course during these volatile times. For specific recommendations and strategies, please contact your D.A. Davidson Financial Professional.